Welcome everyone to our presentation today on the thin capitalisation exposure draft legislation that was released by Treasury on the 16th of March 2023. This session today will be recorded and we'll send the recording and slides to all attendees within 3 business days. We aim to have time for questions and answers at the end of the session, so if you have any questions throughout the session, please submit them using the Q&A button. My name's Alexis Kokkinos and I'm a tax partner in our National Tax Technical Division, and I'm leading our consultation with Treasury on the thin capitalisation measures. I'm also a representative of the Property Council of Australia and I'm involved in the consultation process through the PCA. I'm also joined today by Leo Guzenfeder, who is a director in our National Tax Technical team and is also taking a leading role in our consultation on these measures. Hopefully our presentation today will try and simplify the proposed new changes, as well as outline some of the key items that are being discussed in consultation and what you may need to know for your business in time for the introduction on 1 July 2023. So today we'll be mainly discussing 3 new methods that are being introduced for one class of taxpayer that is required to apply the thin capitalisation measures. So they refer to this new class of thin capitalisation taxpayer as a general class investor, and we'll go through shortly that definition and who these rules will apply to. Generally speaking, however, most taxpayers that need to apply thin capitalisation measures are likely to fall into this new class defined as a general class investor. Of the 3 methods that are being introduced in terms of how to apply thin cap from 1 July 2023, most taxpayers are likely to only qualify in using one of those methods, being the fixed ratio limit or the FRT method. And so we'll be mainly focusing on that method, and that is probably the most important part of the presentation, likely to impact on most of you attending today. We'll obviously be going through the other methods and discussing those methods where you may otherwise qualify. We're going to be talking about how the new methods will impact on interest deductibility from 1 July 2023. We're also going to talk about the new carry forward method in terms of carrying forward any denials that you may otherwise get under the provisions. At the end, we'll also talk about our new calculation module that we've developed that can help perform thin capitalisation calculations for you under the proposed new changes. And finally, we're going to discuss what we believe you should be doing between now and 30 June and what you should be considering going forward in respect to these new proposals. So before we commence, we just want to go through a little bit of background in terms of what brought about these proposed changes. And so this slide covers the historical context of the proposals all the way back to 2014, where the OECD, 2015, where the OECD published a BEPS report in respect of changing thin capitalisation measures. Now, in 2014, the former government introduced amendments to thin capitalisation where they changed what we say is the asset-based module, where the safe harbour ratio was reduced down to 60% in 2014. Accordingly, the government responded to the OECD effectively by stating that they weren't going to be making changes in line with the OECD, simply because they had already limited or had already reduced the scope of or increased, sorry, the ratio under their proposals, and therefore there wasn't as big a need to make amendments under the OECD guidelines. So they decided against actioning the proposals that were made by OECD. In 2022, the current government included as a part of their election promise changes to be made to thin capitalisation in line with the OECD report. Effectively, what they did through the election was to state they were going to target multinationals and limit interest deductions by introducing the proposals with effect from 1 July 2023. Due to the election promise, we believe there's probably very little scope to water down what is being proposed by the current government. However, we are discussing a lot of the measures with Treasury at the moment, hopefully to get some sensible outcomes in respect of some of the issues that we are identifying. So before we go through the proposed amendments, it's useful to go through who is subject to thin cap. Broadly, the amendments don't change who ThinCap will apply to. So if ThinCap currently applies to your group, then it's likely that you're still going to have the same impacts in terms of being affected by ThinCapitalisation going forward. At a high level, ThinCapitalisation generally applies to what we call inbound and outbound groups, and not purely Australian groups. So if you have a foreign parent that owns the structure into Australia, or an Australian group that has outbound investments, then generally ThinCapitalisation can apply to your group. So what the new provisions will do is carve out a category of those taxpayers that effectively are what we call non-financial entities or non-ADI entities, and they're going to call them general class investors. And most taxpayers are going to fall into this categorization of being a general class investor under the ThinCapitalisation provisions. If you're purely domestic groups, again, you shouldn't be impacted by any of these changes, because they shouldn't apply to your group. There are some proposed amendments that they're introducing where they are going to reduce the scope of financial entities. So again, more entities should fall into this general class investor category. They aren't looking at amending any of the de minimis or the existing exceptions. So the $2 million debt deduction de minimis rule should stay as it is. And the outbound entity exception, where you have 90% of your assets effectively in Australia, those exceptions shouldn't be changing. They also have some limited exceptions for insolvency remote and securitization vehicles, which they aren't also proposing to change. So the key thing to identify is whether you will be a general class investor and whether these proposed amendments are going to effectively apply to you, which, as I mentioned, is probably the majority of taxpayers that are subject to ThinCapitalisation. Now I'm going to pass over to Leo, who's now going to discuss these new earning-based methods that are proposed under the legislation.
Thanks, Alexis, and good afternoon to everyone listening in today. And I will provide an overview of 3 new earnings-based tests, and these are all set to apply to taxpayers with income years starting 1 July to 2023 or later. And we'll provide a brief overview and then go through what I'll call some fairly straightforward examples to demonstrate how they work based on the current draft legislation. So, the helicopter view, the 3 new earnings-based tests, they place a direct limit on an entity's debt deductions for an income year if that entity is subject to ThinCap. And this is a contrast to the current approach, which probably applies more indirectly by seeking to indirectly limit debt deductions using a balance sheet as a proxy for an acceptable level of borrowing or gearing. So as Alex touched on, the key rule is this 30% of tax EBITDA test. So the election policy was 30% of profits, that's your limit on your annual deductions for a year. And so that's what we call the fixed ratio test. The vast majority of taxpayers will be in this. The other 2 methods are elective, and it's not expected that many will be able to qualify or meet the conditions to use those. So we'll still go through them, but the key takeaway is, if there's anything, is understanding how the fixed ratio test works. It's the default test, and the bulk of taxpayers are going to be in that test. The group ratio test is slightly, the one change is it limits the debt deductions based on, rather than 30% of this concept of tax EBITDA, which we'll get to, but by what's called a group ratio, which we'll explain as well. So potentially, if your group ratio is higher than 30%, you may get a better outcome under that test. Now, the third test, the external third-party debt test, that replaces what's known currently as the arm's length debt test, and essentially allows all actual debt deductions the taxpayer incurs on what is called eligible or qualifying external third-party debt. Now, some other key things to highlight: that the first 2 methods or tests are based on net deductions for a year, or net debt deductions, being gross debt deductions less items of income in the nature of interest, or calculated by reference to time value of money. And just that could be quite actually beneficial compared to the current rules, which just operate on gross debt deductions. So, for example, if an entity is a net lender, they borrow, pay interest, and they on lend and earn interest at a margin, they should basically have no net debt deductions, and they're not even going to, doesn't matter what the limit is, there's no net debt deductions to disallow. So it can be quite favorable, but if those sort of entities, maybe they earn things in the nature of fees, they might not be considered to reduce their net debt deduction. So that could still be a concern. Now, just to recap briefly, what is a debt deduction? It's the interest is the main one, but it's a bit broader than that. It covers other costs and fees as well as interest. And we'll actually touch on some changes to the menu of debt deduction at the end of the presentation. Another important feature is the carry forward of denied amounts. So currently under ThinCap, if you're disallowed debt deductions, they're permanent. Under the new rules, there's a 15-year carry forward, but only on the fixed ratio test. If you apply the other test, not only can you not carry forward any disallowed amounts, you will lose any prior carry forward amounts that were denied under the fixed ratio test. Now, as Alexis alluded to, these new tests apply to what's called general class investors. So again, entities in a multinational group, either inward or outward, and ones that aren't financial entities or ADIs, which again is going to be the vast majority of taxpayers. So with that brief high-level view, we'll get into the details. We'll go through each of the tests one by one, and obviously focus the most on the fixed ratio test, because that is the default test and the one that everyone's probably going to have to consider. So this test is actually quite simple. Like the deductions are denied for a year if an entity's net debt deductions exceed what's called the fixed ratio earnings limit. And that limit is simply 30% of what's called new concept introduced, tax EBITDA, or earnings before interest, taxes, depreciation, and amortization. And as I alluded to, the net debt deductions are debt deductions less amounts of income in the nature of interest. Now, what is tax EBITDA? And it's something you can probably pull out from a tax calculation and determine very quickly. Start off with taxable income or loss, add back your net debt deductions, add back items of tax depreciation, which includes your normal declines in value of depreciating asset, as well as capital works. But note on that, at the moment, it doesn't include amounts of balancing adjustments, either as a assessable amount or as a deduction. And also doesn't capture at the moment certain other capital allowances like Section 4880 amounts or depreciation for prime producers. But maybe that might move in the final legislation, but at the moment it's just a simple decline in value and capital works that are added back. And also tax losses in prior years that are otherwise deducted in your initial kind of taxable income calculation is also added back. So initial maybe observation is that it's very easy to calculate, very easy to apply, but harder to plan for. Earnings are more volatile, they're harder to predict. And by way of comparison, the current balance sheet test might be a lot easier to plan for because you can sort of set your funding mix in advance and get in within a safe harbor, but it's probably more harder to apply backwards looking when you've got to do all the ThinCap calcs you're required to now under the balance sheet approach. This approach to actually calculate is, again, a lot simpler to apply, but we think harder to plan for. So with that explanation of what the test is, let's just apply it to, I think it's a fairly simple example. So here we have an entity, again, assume it's subject to ThinCap, and currently it's got a 60% gearing. Out of its $10 million of assets, it's $6 million is funded, is debt. So it's within the current safe harbor, and they wouldn't lose any debt deductions, say, in the 2023 year. But going forward, we're going to get a different outcome. So what we have is we've got an accounting profit, but as you know, that $10 million profit doesn't really feed into anything. All this tax EBITDA is driven by tax numbers. So you see we've got $20,000 of gross operating, $20 million of gross operating income and $10 million of net, taking away those expenses. We've got some interest income as well as interest deductions and tax depreciation. So you work through that, normally you get a $4 million taxable income. So that's our starting point in our tax EBITDA. And to get up to our final point in our tax EBITDA, we have to add back the $6 million of add back. So we add back all of our net debt deductions. So that's 3.6 million once you net off the 3.7 against the interest income. And we also add back, the $2.4 million of tax depreciation. So if we've got a $10 million tax EBITDA, our limit is 30% of that. It's always 30%, it's a fixed ratio. So that lets us only deduct $3 million for the year of amounts that are considered debt deductions. Now, in this example, the taxpayer has $3.6 million. So $600,000 is just simply disallowed. It's in excess of the limit, but they can be carried forward to a later year. So in terms of the current year, the result is more taxable income. It goes up by $600,000 and perhaps more tax to pay. And what you might observe in relation to this is that once you're over the limit, basically any extra interest that's deducted is just going to be denied in full. Like you're over the limit, another $1 of interest expense, it's disallowed and carried forward. On the other hand, every other $1 of, let's say, assessable income you earn, it's only going to increase the amount of debt deductions you can claim by 30%. So it's not a kind of a dollar for dollar relationship. You need to earn another $10 of assessable income to deduct $3 of interest income. So to get those interest deductions, you have to effectively pay more tax. So the rules essentially place a limit on how much of an entity's earnings, where that entity is subject to thin cap, can be stripped out via deductible interest payments. It's sometimes referred to as an earnings stripping rule in other jurisdictions. And you might, say that it's probably can be used as a somewhat blunt tool and designed to raise additional revenue. So let's work through again some more examples, which again, fairly straightforward amounts. So here we just want to demonstrate what happens in a loss scenario. So here we've got a $3 million tax loss for the year as a starting point, sort of $2 million net profit from operations, but you take away the interest and depreciation, you're down to a $3 million tax loss. Again, to work out our tax EBITDA, we have to add back those items of interest and tax depreciation. So that, even though we have a tax loss, we still have a positive tax EBITDA, and 30% of that, again, is our fixed ratio earnings limit. So we can only deduct, in this example, $600,000 for the year. This entity has $3 million of interest deductions for the year, so $2.4 million are disallowed. And ultimately, instead of a $3 million tax loss, you end up with a $600,000 tax loss. So not actually more tax to pay in this example, but effectively converts what would otherwise be tax losses into these other carry forward amounts. What they refer to as FRT disallowed amounts, or fixed ratio test disallowed amounts. So rather than having one carry forward tax loss, you've got two different types of carry forward attributes. So one final basic example, this just sort of demonstrates where you might go from a loss or no tax into a tax payable position, and also included a deductible tax loss in this background fact. So you can see the taxable income is going to be zero because we've got, start off with $10 million assessable income, take away operating expenses of 6, interest deductions of 3, tax depreciation of $500,000, and we deduct prior year tax losses of $500,000, taking us down to nil. Again, to work out our tax EBITDA, we add back not only interest deductions and tax depreciation, but also those tax losses. So that gives us, adding back those tax losses is somewhat of a benefit. It gives us a higher tax EBITDA and a higher earnings limit. So again, earnings, the limit is 30% of tax EBITDA, or $1.2 million in this example. So given that there's $3 million of net debt deductions, we will be disallowed 1.8, and taxable income jumps up to 1.8. Now note that entity here might have more than $500,000 of tax losses. It effectively used tax losses to reduce kind of starting taxable income to nil, but there was another, say, $1 million of tax losses, you still might be able to use those. And the effect of these new rules would essentially be to bring forward the kind of utilization of those tax losses, and again might result in more disallowed and carry forward amounts, but you're using up those tax losses earlier. So that's three, again, simple examples of just how the rules work. There, you need to pull out about 4 or 5 figures from your tax calc, and it'll tell you what debt deductions you have and what you don't have. Now, it's probably worth, we mentioned obviously a few times the carry forward rule, and it's probably worth just exploring how that's going to work. So the reason for the carry forward rule is to recognize that earnings are volatile, and while many businesses expect to have, startup losses before making taxable income, it would be unfair to result in a permanent denial in that situation. So it might be an overly harsh outcome just to disallow things permanently where things are expected to fluctuate, or there's expected to be a lead time between incurring interest expenses and earning profits. Now, in terms of how to use this carry forward amount in future years, so there are some tests introduced or included in the current exposure draft. So companies effectively need to satisfy continuity of ownership test or COT. So essentially, if the amounts were a tax loss, could they be deducted? They're applying the exact same test. But what we don't have is a same or similar business test alternative or backup should COT be failed. Now, we think maybe there's a chance Treasury may move on this because I think for policy perspective, if an entity was running a project that was always going to have a delay between expenses and interest expenses and income being earned at the back end, maybe it's a bit unfair if they continue on those activities that they lose all those carry forward amounts just because there's a change of ownership at the top. But at the moment, we don't have an SPT backup. The other interesting thing is there's no testing for other kinds of entities. So the rules are probably very drafted with a very strong focus on corporate taxpayers. So for example, for trusts, they haven't included a COT test for trusts or partnerships for that matter. However, we do think that existing income injection rules that apply both to trusts and companies can apply to any sort of arrangements designed to try to utilize these where there's a tax purpose by injecting income into those entities, because those rules apply to deductions of any kind, not just tax losses. So they already exist as a potential anti-avoidance mechanism. Now, some other points to note about the carry forward rules. There are interactions with tax consolidation. So if a company or a unit trust for that matter had some denied amounts that are carried forward and they're brought into a tax consolidator group, the amounts can be transferred to the head company of the group. There is testing to ensure that happens. There's like a modified COT, but the way we read the current rules is we think in any, let's say in 100% acquisition, you're not going to be able to use them because you're not going to pass COT, whether that's a consolidated group purchasing a company or outside of consolidation. So in any sort of 50% plus acquisition of a company that had these amounts disallowed in prior years, at the moment, you're going to lose all those carry forward amounts unless an SPT modification is made as a backup. And one other thing to note about tax consolidation, where you do transfer these amounts into a group, there is an interaction with your ACA or allocable cost amount, which might reduce your tax cost of assets that are reset. And it works similarly to the way where you bring tax losses into a tax consolidated group. So again, to reiterate, where one of the other two methods, one of the elective methods are chosen, all carry forward amounts are forfeited and you can't carry forward denied amounts that arise under one of those two tests. So again, to carry forward amounts, you effectively have to use the FRT or fixed ratio test every year. So making that election to use the group ratio tests or the external third party debt test is something that needs to be very carefully considered. And again, similar to current rules, amounts that are denied as deductions, you don't get any tax recognition for in terms of going into a cost base of a CGT asset, whether that's a carry forward or not. And obviously the main point to mention there is the carry forward is not indefinite. It's a 15-year carry forward. So yeah, again, that's where projections will be kind of vital, because if you recognize, well, I'm not going to actually recoup those within 15 years, and it's effectively a permanent denial, even though there is a sensible carry forward mechanism. It is time limited and it does expire. So just one further example to demonstrate how the carry forward works. In this example, our entity has $100,000 of tax EBITDA, where we add back all the amounts of interest, which is just our net operating income. That results in a $30,000 fixed ratio test limit, using that 30% fixed ratio. And because there's $70,000 of net debt deductions, that is the $80,000 gross less the $100,000 income, less the $10,000 interest income, we're going to be denied in year one $40,000 of those $80,000 of deductions, but we can carry that forward. So yeah, taxable income does go up in year one, but maybe we can use some of that in year two. So year two, there's no interest deduction. So all we have is, again, $100,000 of tax EBITDA and a $30,000 FRT limit. Now we can use where we have an excess. So this year we don't have any disallowed amounts. We've actually got an excess capacity. Our limit's 30,000, but we're not seeking to deduct any current year net debt deductions. So that $30,000 excess can be applied against prior year carry forward amounts. So out of that 40,000, $30,000 are allowed in this year as a utilization of those prior year disallowed amounts. And we can carry forward 10 to use in the next year or up to the next 14 years. So again, just a basic demonstration of how that works. And with that, I'll pass to Alexis, and he's going to take you through a couple of important aspects of the fixed ratio test as it relates to the grouping mechanism, or should I say, the inability to group.
Thank you, Leo. So I'm just going to cover a few scenarios around grouping and restructuring. What we've gone through is some basic examples on FRT and how we'll apply to single entities. And what will happen is most groups will have more than one entity that's subject to the new FRT provisions. One of the key things in these rules is they're very simple, but they don't have a grouping mechanism, unlike the current provisions that have grouping mechanisms. So you do calculate your FRT on an entity by entity basis. So they're very simple. There are ups and downs on this. The provisions don't disregard any distribution from entity to entity, but you can't pick up any excess that sits in another entity when you've got multiple entities within the group. To demonstrate that, I've got a basic example with a two-tiered structure. We have a holding trust that owns 100% of the units in a property trust. And assume they're both general class investors. The holding trust in this example has $1,000 of interest deductions. It's used the borrowings to fund equity, to fund the equity in the property trust. And the property trust has $10,000 of net rental income. It's claimed $2,000 of net interest deductions, and it's also claimed $6,000 of tax depreciation. So if I apply the FRT method in this example, and some of these numbers are just as given, the property trust itself has $10,000 of tax EBITDA, applies a 30% FRT limit, it's allowed to deduct $3,000 of interest. Because the interest is only $2,000, it effectively gets to deduct all of the amount and has $1,000 excess, but it can't utilize that excess. If we then look at the holding trust in itself just say has $2,000 of tax EBITDA. Assume that's a distribution it's received, tax distribution is received from its subsidiary entity. So funded from that. And if we apply a 30% limit to that, we effectively get $600 as an FRT limit in this case. Given that there's $1,000 of interest deductions in this example, applying the limit of $600 means it will deny the entity $400 of interest deductions. So its taxable income is going to be $1,400 of taxable income, allowing it to have $600 of interest deductions in the example. So in this case, even though on a group basis, we don't really have an issue, by applying it on a single entity basis, we can get a denial. And that can be demonstrated by this next slide, which shows what would happen if we didn't have a two-entity structure, but had just a single entity, or if they allowed for some form of grouping. So in this case, we would have had $3,000 of net interest deductions that is applied at the group level. Now, if I took out the trust distribution, tax EBITDA would be $10,000. Apply a limit of 30% to that, we would have $3,000 as an FRT limit. So essentially, we'd be able to deduct all our interest deductions because our net interest deductions is only $3,000, which would mean our taxable income for the group would just be $1,000 of taxable income. So as you can see, by having the two-tiered structure, in this case, without any grouping, we've lost $400 worth of interest deductions when we otherwise probably shouldn't have. Now, this can give rise to, if they don't introduce a group provision, then many groups would need to consider whether they can restructure or change things to get a different outcome. So if I jump back to the previous slide, and as was outlined in the previous slide, you had the holding trust borrowing to inject equity into the underlying property trust. So it may still do that, but what it might have is the property trust, which has at least equity equal to that borrowing, it may decide to return capital. So previously you may have had an equity stack that was compliant with the old thin capitalization provision. So 60% of your assets was backed up by effectively equity. So you may not need that essentially going forward. So you might return equity up to the holding trust. And in this example, the holding trust may re-lend that down to the property trust at interest. So for example, if it re-lent it down and charged $1,000 of interest income down to the property trust as $1,000 of deductions at the bottom level, what happens is we look at the holding trust and it has the concept of net interest deductions being applied to it. So it has $1,000 of expense, $1,000 of income, so its net interest deductions now are reduced to zero. So it won't have any FRT denials at that entity level, at the holding trust level. Then if we look at the subsidiary property trust, it now has interest deductions of $3,000, picking up the new loan that was provided by the holding entity. So it's got $3,000 of interest deductions, but also has a $3,000 limit. And again, there'll be no denial. So a simple case of restructuring the equity stack and the debt stack in this two-tiered structure shows how restructuring may change the overall outcome. So if I turn to the next slide, and what we'll do in this slide is just discuss a little bit about how restructuring may have impacts, and different forms of income classes derived by entity may have impacts to the FRT. So we're revisiting the example Leo went through, which was example 1, where we had taxable income of $4 million, a tax EBITDA of $10 million, a fixed ratio of $3 million, so 30% of the tax EBITDA, and we had net debt deductions of $3.6 million. So in this example, as $3.6 million exceeded the limit of 3, we were denying $600,000 of interest, and we're carrying forward that $600,000. So our taxable income was $4.6 million. So in the first scenario, let's just assume that they re-changed the way that they're funded and they used some of their excess cash or excess borrowing to re-lend that out to other group entities so that they start deriving further interest income. So in this example, just say we derive $600,000 more of interest income. What happens in this case is because the interest income reduces effectively our net debt deductions down to $3 million, there is no excess net debt deductions in this example. So $1 of interest income will effectively reduce $1 of net debt deduction. So it's almost a dollar for dollar match when you earn more interest income. So restructuring the loan composition can give rise to a complete change of the what's otherwise denied. Now, obviously, because you've got more income, your taxable income has still gone up to 4.6 million. So you still have more taxable income in this entity, but it's obviously charging interest to another entity that might have had excess capacity, and it might get a deduction for that 600,000 in the other entity. So on a group basis, you may be better off by 600,000. If I then go to the last example, so this entity might derive more assessable income. It could be through a distribution from other entities. It may be from deriving other income. What's worth noting is that this income in this example has gone from 4 million to 6 million. And because we apply the cap of 30% to income, our cap has only increased to 3.6 million in this last scenario. So although we're not denying any debt deductions because our debt deductions are still 3.6, our cap's 3.6, we've increased our total taxable income up to $6 million. because we've had to derive $2 million more in order to get a deduction of $600,000. So this last item, just to understand, is obviously by introducing more income into this entity, you need to derive income whereby you only get a 30% increase in the capping. And now this last part might give rise to considerations of restructuring where more income goes into a group. You might consolidate entities, whereas the scenario we talked about, extra interest income, may be a consideration around restructuring debt. There are obviously broader impacts for the group in terms of where expenses income is situated, whether you get deductions on lending. And obviously, if all you're doing is restructuring to get access to tax benefits, you'd need to consider the anti-avoidance provisions of Part 4A. So I'll pass back over to Leo now to go through the group ratio.
Thanks, Alexis. So that's the fixed ratio test, and we'll take you through the other two tests. So first is the group ratio test. Now this denies the excess of net debt deductions over what's called the group ratio limit, which is, again, you start with your tax EBITDA, but you multiply not by the fixed 30% ratio, by something you can determine based on accounts called the group ratio. And again, that can only be obtained from audited consolidated financial statements of a worldwide group. And that requirement might make it impractical to apply for many group structures, particularly where there's things like discretionary trusts in there. And as also mentioned before, it requires an election, which is set to be irrevocable, but to clarify, the elections under these rules are year by year. So even though they're not permanent in terms of you apply the election and it's going to be using this method forever, it's just that once you make the choice for a year, you can't go back and change it with the benefit of hindsight like 2 years later. And another requirement is you can't use this method if your group EBITDA is negative, because you get a negative limit and it wouldn't work anymore. So that's a small limitation there. So what is the group ratio? That's the key. That's the thing that's replacing your fixed 30%. And what it is the group's total net third-party interest expense over the group's total EBITDA taken from those accounts. The idea is that for more highly leveraged groups, if they can prove that the entire group pays, say, 50% of its total EBITDA as net interest, then it should be able to deduct its net interest at this same ratio in line with the group. And it sort of demonstrates there's no higher allocation of debt to Australia, driven by some sort of tax benefit. So there are a few adjustments to make to these numbers to get your group ratio. It's not just from the accounts. There are adjustments to include amounts not actually disclosed as interest if they're economically equivalent to interest or under the nature of interest. There's also exclusions from both the denominator and the numerator for in dealings with associate parties that give rise to interest. So an associate for these purposes are determined on a 10% plus control basis. So actually could bring in a lot of entities there. And the idea is that it's an integrity measure to prevent related party interest from increasing your group ratio. Lastly, there's also an adjustment to exclude individual entities that have a negative EBITDA from the group EBITDA calc. And I think this is to prevent an overly low group EBITDA, which may cause the ratio to be excessively high. So you can see this starts getting a bit more complex than the fixed ratio test, which is just, you're told it's 30% full stop, whereas this has a lot more bells and whistles to it. Not quite as simple. So, but we will try to go through an example to demonstrate how it might work if you had all these sort of numbers on hand. So we have on the left-hand side Ausco as a standalone entity. It's got net operating income of $1 million, some related party interest, some unrelated party interest, some interest income, and some tax appreciation. Now, those are all tax numbers, but it might look to its worldwide group accounts to pull out a group ratio. So here on the numerator, you'd work out the group's net third-party interest expense, which is the $70 million total, and you exclude the $20 million that are paid to associates. So then you count $50 million in the numerator. And on the denominator, we have our group EBITDA. So we start off with a net profit before taxes at 50 million. We add back the interest, but only the third-party interest. So we only add back the net of 70 less 20. And we also add back these negative EBITDAs of entities within that worldwide group, as well as the depreciation and amortization expense. And we get 50 million as our numerator, as our third-party expense, 125 million as our group EBITDA after all these adjustments, resulting in a 40% group ratio. So that's clearly better than 30%, and you would potentially seek to apply the group ratio test if these were the facts. So, because under the group ratio test, you apply it to the exact same thing. You applied a higher ratio or higher percentage to the exact same thing called tax EBITDA. So instead of being able to deduct up to 300,000 for the year, we may be able to deduct 400,000 for the year. So rather than a $300,000 denial, there'll be a $200,000 denial. But this is where the trade-off comes in, because under the fixed ratio test, there's ability to carry forward. But under the group ratio test, there isn't. So that $200,000 could become permanent, whereas under the fixed ratio test, that $300,000 denial might only be temporary. And again, the need to make elections by lodgement day and the inability to change those for that year makes it hard to work out in hindsight what the right things to do. So it does require a bit of prediction and forecasting in order to kind of confidently make a choice to apply the group ratio as opposed to the fixed ratio test. And just one last point on the group ratio test, because it is basing things off accounting concepts. To work out a group ratio, it's purely determined based on financial statements. It's not based on tax concepts. So these where the book to tax differences could lead to some maybe strange outcomes. So this is sort of the example Alexis went through with our two trust structure. And if we group them, we might have $10,000 of net rental income, $3,000 of interest expenses. But under accounting, in year one, the group revalues a property by $20,000 upwards. Now that upwards increase in your group EBITDA, which is on the denominator, causes that group to have a very low group ratio for the year, only 10%. So $3,000 of your interest expenses over that $30,000 group EBITDA. And the depreciation and amortization might not be recognized in these accounts depending on the accounting standard being applied. Now, in year two, it might go the other way. There could be a big impairment that otherwise takes your group, your EBITDA from what will be $10,000 down to $1,000. Now, again, a very small denominator could lead to a very, very, very big group ratio. In this case, 300%. And you might get some extreme examples as you tend towards nil for your group EBITDA, your group ratio could tend towards infinity. So you could get some 1 year where you get a ridiculously high group ratio, thousands or millions of %. And that probably is the reason why you don't have a carry forward under these rules, because if you can, 1 year you get a really, really like almost infinitely high group ratio, it would allow you to use up all the prior year denied amounts almost as an anomaly. So that, again, that's probably justifies the lack of a carry forward rule under the group ratio. But just something to be wary of here. This is, you ultimately apply the group ratio to taxable numbers, but in working out the group ratio, it's solely driven off accounting, which can lead to some vastly different outcomes. So that's the group ratio test. So let's now go through the external third-party debt test. This one effectively allows an entity to deduct interest to the extent of genuine third-party borrowings and replaces the arm's length debt test for general class investors as well as financial entities. So financial entities can elect into this as well. Now, the tricky aspect of this is, in addition to the actual key requirements, is that there's a mutual choice requirement. So the taxpayer who seeks to make this choice needs to also have all of their associate entities that are general class investors to also make the same choice. Now, this, where you have particularly where you got joint ventures in the group, it might make it almost impossible to do. But that mutual choice requirement is something, I guess, we're talking to Treasury on, because we feel like it can be tightened. But as it is, it casts a potentially very wide net. It might require many entities, potentially hundreds, to make the same choice for that year, which, if that's the case, would be almost impossible to do. So what actually is this test? It only disallows gross debt deductions over what's called the external third-party earnings limit. And that limit is the actual deductions for the year incurred in relation to what meets the definition of external third-party debt. So what that is, to qualify external third-party debt, it must be issued to unrelated entities on a 10% plus basis. So they can't be associates that have any 10% interest in the entity seeking to make this choice. But unlike the arm's length debt test, it doesn't have to be issued to, for example, or compared by reference to commercial lending institutions. It can be any third-party lender. The most severe restriction is that the lender can't have any recourse to assets beyond the entity's assets in relation to that debt. So any directed guarantees or cross-collateralization might just cause this thing not to meet the test as being external third-party debt, which might again make it impractical for many groups to apply this because there's generally security taken over other entities' assets or guarantees given by other entities. So that's a big stumbling block potentially. And another requirement is that the funds borrowed must be used solely to fund Australian investments or operations, another condition. And key thing to note is that failing to meet one of these things means, well, that debt isn't considered third-party debt. But you can still elect into it mistakenly thinking you did satisfy this. So there's, again, you have to be very careful because you might elect in, fail one of the conditions, but you've already made an irrevocable choice. So your earnings limit might actually be nil and you can't go back to the fixed ratio test once you've made this election for that year. And I'll just race to this one quickly. There is a rule to extend this to on lending where you might have, let's say, a central group treasurer entity. So in this case, it might have a $5 million loan from a bank. That might satisfy the external third-party debt test. Now, if that group treasurer on-lends to related parties on the same terms, which is, again, what does that mean? Might be a difficult condition to satisfy, but if they do meet that same terms requirements, those borrowers, those ultimate borrowers, can also treat that related party loan from the group treasurer as also external third-party debt. But there's a very almost strict, tracing back to the bank to show the same amount that was borrowed was on lent to the borrower. So just one example of how this might apply. In this structure, we've got a property trust which obtains senior funding from a bank to fund development, and let's say mezz finance from a related party that happens to be considered an associate entity that holds 10% plus in the property trust. And very simply, if we assume that that bank debt meets all the third-party conditions, all this test says is that you can deduct up to $20 million being the actual deductible interest in respect of that third-party debt. And the consequence is you lose deductibility of all that $5 million of related party debt. And well, the consequence that the lender is still assessed on that $5 million on the income coming in. So very simplified explanation of how it works. You get all your deductions for external debt, you don't get any for any related party debt. And the need to do this mutual choice might be an issue because maybe you go, well, it's not ideal to lose $5 million of debt deductions, but maybe that a related party wanted to make that election because it optimizes their position and it might bring in the property trust as well as needing to make it in order to satisfy that one in all in principle. So I just want to quickly revisit example 5, where we just tack on this third-party debt test to it. So what I just want to highlight is that in those facts, we had $500,000 of third-party interest expenses. And this is the first two columns show the results we got to under the first two methods. And this method would say, well, I've got an earnings limit of $500,000, which is simply my external third-party debt deductions. I've got gross debt deductions of $650,000, so I'll only lose $150,000 of deductions that year. Again, that's a permanent denial. So if this is your scenario, you might need to consider well, one's a temporary denial, one's potentially permanent. And again, the external third-party debt test may seem more favorable than the group ratio test, but that electing into that third-party debt test might pull in all of your other associate entities, or rather would require them to also make that same choice in order for you to access that test. So a lot of considerations to think about. So those are the three earnings-based tests. And we just quickly wanted to highlight some other changes in the exposure draft, which kind of were unannounced and maybe somewhat of a surprise. I'm conscious of time, so I'll race through these fairly quickly. There is a proposed repeal of section 2590, which allows allows companies to deduct interest that are used to equity fund foreign subsidiaries. Because normally those have a nexus to tax-exempt dividends, but there's a special provision that preserves that deduction. Now, those interest costs to fund those foreign equity investments will be non-deductible. So it's going to have a potentially significant impact for outbound structures, especially whether they're subject to thin cap or not. Also, the meaning of debt deduction has been expanded. It's not limited anymore to costs incurred in relation to debt interests under the debt equity rules. It can apply more broadly, things that aren't necessarily considered debt interest, but so long as they're determined by reference to time value of money, you might bring in more things, which again, subject to denial under the new thin cap rules. As Alexis mentioned, they're reducing the scope of financial entities. So entities registered under the Financial Sector Collection of Data Act are no longer financial entities, and they might be considered general class investors and have to apply the fixed 30% test. And the last point is there was an interaction sort of change with the transfer pricing rules, which now require an entity to both consider the quantum as well as the price where you have debt that's cross-border related party debt. So currently, under the current rules, you only have to consider the price of that debt, and you can ignore the quantum because we have an existing safe harbor. But now that's all gone. In applying the arm's length principle, you have to consider both factors, quantum and price. So any such arrangements that exist now might need to be reviewed going forward from 1 July 2023, because you will now need to consider the quantum of debt borrowed in Australia as well. So I'll hand back to Alexis to round off today's webinar.
Thanks, Leo. So just to conclude, the start date of these provisions is 1 July 2023. There's only now roughly less than 3 months to consider the potential impacts of these provisions. We only do have an exposure draft at the moment, but for most groups, we're expecting there to be significant denials of interest deductions under the proposed methods contained in the ED. We do have now interest rates rising, so higher interest expenses, pressure on margins. So we are expecting that arrangements your entities are going to be impacted potentially significantly under these proposed amendments. So there's absolutely some opportunity now to consider whether you're going to be impacted. Are there opportunities to restructure? Obviously, if debt arrangements in place with third parties, it does give rise to risk around trying to restructure debt in terms of changes to any terms and conditions you may otherwise get. So there are really important considerations that are needed by most groups between now and 30 June. So Pitcher Partners, we're heavily involved in consultation with Treasury, as I mentioned earlier, both as Pitcher Partners and through the PCA. My personal view is that we're unlikely to receive very many amendments to legislation. As I mentioned earlier, this is an election promise. They do need to get this through. They do want to have this applicable from 1 July. And a lot of the things being proposed as amendments are very complex and would be very difficult for, I think, Treasury and the government to accept. So we believe that most of the rules will be fairly similar to what we currently have under the legislation. Under the FRT method, performing single entity calculations are probably not going to be very difficult as it's based on information from tax returns. However, when there's groups involved, it's going to be quite complex to determine which entities are going to have potential denials and also where excess capacity may otherwise be. Which leads us to this slide that is up at the moment. What we've done at Pitcher Partners is we've developed a tool that can assist group calculations to be performed. So it's a model, basically uses your trial balance to upload it into our model tagged for the new provisions. And essentially you input your tax return information required, and it helps calculate your earnings thresholds under the 3 proposed methods. What it tries to do is help identify those entities that have potential excess capacity, as well as those entities that might be subject to denials in the group based on current data. You can use projected data, but it tries to help understand relatively quickly what your group position may otherwise be. It's a tool that's available to our Pitcher Partners staff when they're assisting you in trying to understand the new proposed rules to your group. And if you'd like for us to be involved in performing this analysis, please contact your Pitcher Partners representative. So that brings us to the end of our session. I know we've only got a few minutes left. So what I'm going to do is I'm going to turn to Leo to take us through any questions that were raised during the session.
Yeah, so just a couple of questions, Alexis. I guess the first one you might have touched on, but I'll ask anyway. It says, I have a number of trusts in my group. If there are no grouping rules, will I be able to distribute income between the entities or restructure debt?
Yeah, this is, I think, going to be a really important question, Leo, for many groups in our sector, because they operate through discretionary trusts. At the moment, trust distributions aren't removed from any calculations. So if an entity does need more income, distributing trust income through to another entity could give rise to a higher FRT limit. So at the moment, no limit, but they may decide to put in rules that exclude intragroup distributions. But that being said, if we don't get a grouping rule, as I went through in the presentation, I think that most groups are going to look at their debt capital structure and where they're able to move debt and interest expenses around to get a more appropriate outcome. Obviously, the key thing on this item, though, is restructuring to give rise to higher debt deductions might give rise to the anti-avoidance provisions of Part 4A. We are asking Treasury and ATO to come out with guidance to say if you do restructure to fit into the provisions, they shouldn't be seeking to apply Part 4A, which they've done recently for other provisions in terms of practical compliance guidelines they've released. So we're hopeful that they'll do something similar, because otherwise there would be a risk on trying to restructure just to obtain deductions under the ThinCap provisions.
Thanks, Alexis. And I think just a comment to add, because I don't think I actually put on the slides, is that there's no transitional or grandfathering rules. So existing structures are just brought in. They can't preserve any sort of existing treatment. Yeah,
that's right. It's a hard cutoff date from 1 July. You switch over to the new methods. And unfortunately, you apply the new methods from that date. There's no average calculations as there were under the old provisions. You're strictly applying a 12-month calculation based on your tax EBITDA and applying the 30% threshold to that. So it is quite a harsh set of provisions, even though they are easy to calculate.
Yes. Lastly, you probably alluded to it a little bit, but do you expect anything to change between this draft legislation and the final legislation that gets passed?
Yeah, so obviously Treasury are open and they're having a lot of consultation meetings at the moment to discuss some of the issues. I just think that they have to, effectively have the final legislation ready by the start of June, which leaves them 8 weeks to finalise the legislation. The things that are being raised, such as grouping, trust interactions, etc., they seem very complex type changes. Essentially, it's going to be very difficult for many of those things to be incorporated in the legislation. So I don't expect a lot of changes to be made in the final legislation.
And actually, a question did just come through. Might have a minute to answer it very quickly. It says, is there any de minimis threshold on the denial of Section 2590 interest deductions?
So currently it's a complete removal of 2590, no transitional being discussed. Effectively, it's going to apply from 1 July 2023.
So even if you only have $1 of that, you'll be denied the $1. There's no that's not linked to the ThinCap at all. It's actually sits out. It's completely outside of ThinCap.
Yeah, exactly. Unfortunately, they're looking at removing that provision. People are asking for transitional relief to allow them to restructure, but currently the way it's been drafted, it is a complete denial from 1 July onwards. Okay, that's all that are the questions. I think that brings us to a close for the session. So I'd just like to thank everyone for attending this session. Again, if you would like to talk about these new measures, please contact your Pitch Partners representative, and we're more than happy to discuss how it might impact on your business. And thanks for attending. Thanks very much. Have a great day.
Thank you, everyone.